Welcome to episode 2 of the Falling Knife Project, where we're trying to turn $25,000 into $750,000 in 24 months by trading options. Today, we're going to skip over my resume and talk about the strategies. One thing I will tell you is that I've been trading 0DTE SPX options for about 5 years. Selling options is what I prefer, but for this project, we're going to be buying options because of how aggressive our growth target is. So let's get to it. We'll be trading one ticker and one ticker only, and that is SPX. That's the S&P 500 index. And we'll be running 7 strategies. We've got a volatility crush trade, an inside day replicator, an oscillator, or at least that's what I like to call it, a trend trade, and 3 tinker trades that are smaller trades that complement the other 4. Not sure what I'm talking about? No worries, I'll be covering each of these trades in more detail in episode 4. So here you can see the equity curve for the back test of this ensemble starting in May of 2022. This is the time period we're most concerned with modeling our portfolio after, because it's when SPX started offering daily option expirations. Prior to that, it was 3 times per week, and then 1 time per week before that. But even if you ran this back test for this ensemble back to 2013, this portfolio still performs pretty well. So either this setup works or the market's trolling me, which it wouldn't be the first time it did that. Back to the equity curve. So you'll notice this curve tops out around $350,000 after 3 years, not the $750,000 target after 2 years. That's because in this example, we are not scaling. So in real life, if we grew our account from $25,000 to $50,000, we'd also double our bet size, and here we did not. We'll talk more about scaling next episode, but today I'm most interested in what our maximum drawdown is to see if this project or mission is even viable. Why am I so concerned with max drawdown? Well, there's something called sequence risk we need to look out for. So simply put, we might get unlucky at the start of this project and start it at the worst possible time. So I've marked some of these worst times with red arrows on the equity curve. Another way to think about sequence risk is the market chooses the road that we start on, and we have to be ready for it to be the roughest road possible. So for this ensemble, starting at the worst possible time would have resulted in an $11,922 drawdown. A trader rule of thumb is to assume you're going to double your back-tested drawdown at some point when you run it live. So if we went to double what our modeled max drawdown was, we'd be at around $24,000. In which case we'd be flirting with blowing up the account. So you can see there's a good opportunity for us to be successful in this project, but also a serious risk of blowing the account up. Other stats to note are that our average daily loss when we do lose is $937. Our maximum daily loss was $6,300-ish, and we win on 53% of the trading days. So we've got 1 ticker, we've got 7 strategies, and we've got drawdowns large enough to make my hair turn gray. Next episode, I'll show you how to run a Monte Carlo simulation to quantify this risk of blowing up, and we'll also go live. I'll show you guys the first week or couple weeks of results. If you want to see if I blow this thing up or pull it off, follow along.